Everybody wants financial freedom, and if you need that, of course you know you're going to have to make some investments. But what should you be investing in? In this video, I'm going to share with you 6 basic investment strategies, the essentials of investing that every good investor looks for. Hi, my name is Tyus. I make videos about personal liberty, escaping the rat race, living your freest life possible. If that's something you want, and it's something that everybody wants, then hit the subscribe button, hit the notification bell so you're informed when I drop another video, which happens to be every Monday and Friday. On this video, we're going to be talking about financial freedom, which is all about making more money than you spend to live the life that you want. I mean, who cares about making money if it costs more to make the money than you earn? Or if you don't have time to enjoy it, or if it comes at the expense of all of your friends. I mean, we want to have it all, and that's what I want to teach you. I want to share what I've learned up through my life this far. I'm sure I'm going to be gaining more skills as we go along, and I'll share those with you. But stay tuned through the end of this video so that you know exactly what a successful investor looks like. There are hundreds of thousands, if not millions, of different types of investments out there, whether it's stocks or bonds or real estate or currency trading, which could be like foreign currency or cryptocurrency. It could be owning a business or being an angel investor. Even having a day job is a form of an investment where you're investing your time in exchange for money. Ultimately, it's not about the investment. It's about the characteristics of the investment that determines whether you live the life that you want. So let's look at the 6 big characteristics of investments that great investors are looking for. And those are production, ownership, choice, risk, cost, and potential. Now we're going to look into each one of these in greater detail. We'll start with the first one, which is production. Does it produce cash flow? I mean, all investments really should. There's 3 ways to think about cash flow. The first is, does it produce more value than it consumes? This is really the role of businesses out there. They try and create either a product or service that is higher in value to a consumer than it costs them to produce. This is also the realm of a day job. In a day job, you're trying to provide more value to a company than it costs them to pay you. And if that continues, well, then you've got a working relationship for life. The second way to think about cash flow is in perceived value. Things like real estate. You might buy a house and the perception of the value of that house goes up over time. So you'll be able to sell it for more than what it was worth when you bought it. This is also the realm of cryptocurrency. The third way to think about cash flow is that of compounding. Now you hear a lot about compound interest, but it's really one of the greatest forms of power you have when you're talking about investing, and this really falls into the realm mostly of stocks and bonds. The second characteristic to consider when investing is ownership. And that all comes down to control. Do you have control over the asset, the investment, the choices that are made? Can you set the price? Could you determine when you can buy it or sell it? Or do you get to have managerial choices over it? Now, if you're a business owner, you have a lot of choices, a lot of control, a lot of ownership over that investment. This is also something that happens a lot for real estate investors. They have a lot of control over that asset. But if you buy stock, you might be at the mercy of the company that issued that stock. If you are an investor in cryptocurrency, you're kind of at the mercy of the market. It could go up, it could go down, and you don't really get to control that. The next characteristic to consider when thinking about an investment is that of choice. And choice is all about flexibility. Does it give you a lot of options? Are there multiple ways that you could be making money? Or are there multiple exit strategies if something goes wrong? Now, I don't mean to rag on Bitcoin, but it's not something that I invest in. And one of the reasons for that is there's not a whole lot of choices involved with it. You either buy it and sell it or you don't. That's not a lot of choices. Bonds are the same way. Now, if you have a day job, you've given up a great many choices to give to your boss. They get to decide whether you work there or not. You don't have that level of choice. On the other hand, if you choose to own your own business, which is a fantastic investment by my opinion, well, you have a lot of choices. You have a lot of control. There's a lot you can do with that. Real estate is another one of my favorite forms of investment, and it's because you can do a lot with it. Wholesaling, flipping, renting. I took about $26,000 and converted a section of my house into a short-term rental. And I did it because there was a lot of choice within that opportunity. I could either do it as an Airbnb, or if that didn't work out, I could do it as a VRBO. If it didn't work out as a short-term rental, I could turn it into a long-term rental. And worst case scenario is that it increased the equity in my house. There were lots of options with it. If you want to learn more about that, I did create a video on that particular project, and that allows me to live in my house for free. Having lots of choices is a great way of reducing the risk of an investment, and that is the next characteristic I want to look at: lowering your risk. Now there's three ways you can do this, three primary ways. There's some smaller ways, but the three big ones is first, diversification. And that just means that you invest in something that is counter to a primary investment. So for example, if you invest in Coke, you might also want to invest in Pepsi, because if one goes up, the other one might go down, and it protects you from risk. Now, both of those are in the junk food category, so maybe you want to invest a little in junk food and a little in health food. So if everybody jumps ship from eating junk food, well, they might be moving over to eat healthy foods. Or stocks versus bonds is also a classic version of diversification to protect an investment. So that's the first way, diversify. The second way is liquidity. And what that means is you can easily turn the investment into cash. You could sell it off, or you could just turn it into cash really, really quickly. Some investments have a really, really hard time doing this. For example, if you're an angel investor and you give $1 million to a new .com company, well, it might be very, very difficult to get that money back, because the company might not be worth the $1 million you invested in them for a long period of time, and they won't have that money to return to you. The third way of protecting your risk or lowering your risk is that of portability, and that means, can the investment move with you? Now, I gave a lot of heat to Bitcoin earlier. However, Bitcoin is really great in this. As far as portability is concerned, it's got to be probably one of the top investments for portability. And while I love real estate, it doesn't move with you. It's really bad at portability. The next characteristic we want to look at is that of low cost. It's a myth that it takes money to make money. It's not always true. Money can actually be counteracted by time and quality. So if you need to get into something for low cost, and you need to do it really, really fast, you can probably do it, but the quality will be very, very low. If you need to get into something at low cost, but it needs to be really high quality, well, you can probably do that too, but it's gonna take you a lot of time. Those are relative agents within price. So there's a few things to consider, and most people, when they think about cost, they think of cost of entry. That's gonna be the cost of acquiring that asset. So a lot of really, really great investments have really, really high costs of entry. If they didn't, everybody would have them. So things like real estate, owning your own business, angel investing, all of those have really, really high costs of entry. And it's partially why they're really great investments. But there's other options, there's other investments that have incredibly low costs of entry, barriers of entry. For example, penny stocks, incredibly low. A day job, zero cost of entry. And cryptocurrency has a really low cost of entry because it's so divisible. Another way to consider cost is operating costs. So while having a day job has almost zero cost of entry, it actually has a pretty expensive operating cost, because your greatest resource is your time, and a day job is going to take out a lot of your time. Owning a business can also have astronomical operating costs depending on what kind of business you got into. Things like rental properties or stocks or Bitcoin, again, has incredibly low operating costs, if not zero operating costs. Now, if you are in a business or have an investment that has high operating costs, things you can do to reduce that is, one, you can automate things, or you can deal with things on an economy of scale. That will help reduce those operating costs. Now, the last thing that investors are looking at oftentimes with cost is that of taxes. Taxes are massive as an expense, and so a lot of investors look deeply into different types of retirement accounts or tax loopholes or tax advantages whenever possible. I also made a video on why taxes are evil, which I will link here. So lastly is potential. That is the last characteristic. And that is, could this investment have explosive growth? Now, it might be worth it to have something that you get less control over, and you have fewer choices, and you have higher risk, and you have greater upfront costs if the investment has a massive rate of return. If it's high enough, people will often invest in it, even if all of the other variables are off. But I will tell you, the reason this is last on the list is because smart investors prioritize this last. They know that giant wins are rare. They happen very rarely, and most people that get rich slow, which means they're not taking crazy risks. Bad investors are always looking for the get-rich-quick scheme. So when they see a high rate of return, they might lose all their senses, put all the other characteristics aside, and still make that investment. Ultimately, generally, it's going to lead to a huge loss. Okay, so let's recap. Those 6 investment essential characteristics are production, ownership, choice, risk, cost, and potential. Here's the bad news. The bad news is there's no such thing as the perfect investment. It's always going to be a balance of those 6 characteristics, and what your skill sets are. Some people can handle greater risk. Some people can handle higher costs. Everybody's going to be different, but what is good news, the good news of this is now you know what to look for. I hope you're enjoying these videos. If you are, please subscribe if you have not yet done so. Share these videos with people that might enjoy it, and I hope to see you on the next one.